Imagine you're at a party, and someone walks up to you and says, "I've got a deal where you give me a big pile of cash now, and I'll send you a check every month until you die." Weirdly enough, that's basically an annuity, and it's one of the most misunderstood tools in all of retirement planning. Here's the scary part nobody likes to talk about. You might actually live a really long time. We're talking into your 90s, maybe beyond, and your savings have to somehow stretch across all those golden years. Like you're rationing snacks on a very long road trip. That's where longevity risk comes in, which is just a fancy way of saying you might outlive your money. An annuity essentially transfers that risk to an insurance company. So instead of you sweating through every market dip, they're on the hook for keeping your lights on. The way it works is pretty simple at its core. You hand over a lump sum, and in return, the insurance company promises to pay you a set amount regularly, often for the rest of your life. Think of it like buying a subscription to your own paycheck, except the content is just being able to afford groceries in 2040. Now, not all annuities are built the same, and this is where it gets a little spicy. There are fixed annuities that give you a predictable, stable payment, variable annuities that tie your returns to the market, and indexed annuities that kind of split the difference like a financial Switzerland. Fixed annuities are the boring, reliable friend who always shows up on time. No drama, no surprises, just steady income. Variable annuities are more like that friend who might make you rich or might lose your luggage. The market decides, and you're just along for the ride. One thing people seriously sleep on is the fee situation. And oh boy, can fees get wild with annuities. Some products stack surrender charges, mortality fees, administrative costs, and rider fees until your guaranteed income starts looking a lot less impressive once you do the math. A surrender charge is basically the insurance company's way of saying, you can leave, but it's going to cost you. And those charges can last anywhere from 5 to 10 years after you buy. So if you need that money back sooner than planned, you could be looking at losing a meaningful chunk of what you put in. Here's a perspective shift that helps a lot of people. Think of an annuity less like an investment and more like insurance against a very specific disaster, specifically the disaster of running out of money. You wouldn't complain that your car insurance didn't pay off because you didn't crash. Same logic applies here. Annuities work best when they're part of a bigger team, not the whole squad. Social Security, pensions if you're lucky enough to still have one, a retirement account or two. Annuities slot in to cover the gap and make sure your baseline needs are always met no matter what the market does. A common misunderstanding is that annuities are just for wealthy retirees writing enormous checks to insurance companies. Actually, you can start some annuities with relatively modest amounts, and for someone who wants to guarantee they can always cover rent and groceries, that peace of mind has real value. The timing of when you buy also matters a lot. Annuities purchased closer to retirement tend to offer better payout rates because the insurance company isn't on the hook for as many years. Buying one at 45 versus 65 is a completely different ballgame in terms of what you'll actually receive each month. Before signing anything, you want to read the terms like your financial future depends on it, because it literally does. Ask specifically about the payout rate, the length of any surrender period, what happens to payments if you die early, and whether there are inflation adjustments built in. The inflation question is a sneaky big deal because a fixed payment of $2,000 a month sounds great today, but in 20 years, that same $2,000 might not cover what $1,000 covers now. Some annuities offer cost of living adjustments, and while they reduce your initial payment, they protect your purchasing power over the long haul. At the end of the day, annuities aren't magic, and they aren't a scam. They're a tool, and like any tool, they're only useful if you understand what you're building. If you want to learn more about how our company can help you navigate annuities and retirement planning, check out the links in the description. Are you curious enough to take the next step?